YouTube, this is the Working Investor. Today I'm going to tell you why I'm very excited to try out the 0 and 1 day DTE, data expiration options. The biggest reasons why I want to do it is because of the money, because of the return on the rate of return on investment. Your rate of return is your superpower of how fast you can accelerate being indemnified servant and complete your indemnified servitude to your primary job. You can work optionally and not obligatorily to your job, and you can free yourself and do what you like. So let's say, for example, right now we're in the weekend post market, but let's look at Monday, June 10th. And I like to look for a 0.2 to 0.3 delta. So let's look over here. We have the 532 strike in the S&P 500. The 532 strike is trading for $56. Let's round it down to be more conservative, $50. Obviously, when the market opens up, it'll be less because there's less days time to expiration. So let's even say $40. Let's compare that to 4 weeks out with a similar delta of July 5th. And just before we get there, just bear in mind the strike price, the actual price is 533.31, and we're talking about $1.31 out of the money. So it's pretty close to the money, but again, the delta expected move, I guess, is it's 70% going to be not going to reach below that, but of course it could. July 5th, let's go to a similar comparable delta. Let's go to the 0.272. It is close enough, and it's a 525 put, which feels safer because it's $8.31 out of the money from today, from now. But bear in mind, there's 4 weeks, there's 19 trading days because there's a holiday, still 19 full trading days that the market could move in any direction. There's actually 4 full weeks because things could happen on the weekends that can cause gap up, gap down. So there's around 4 full weeks that this can move. So it feels safer, but it may not necessarily be safer. And look at this. Let's say the premium is $360. Let's say you want to say it's $300 because the market, just for even numbers. Let's compare $40 for 1 day versus $300 for 28 days out. If you do the math on this, so let's say $40 a day for the 1 day to expiration or 0 day to expiration. I kind of put them into one category, but I know they're kind of different, and we'll talk about that. So there's 4 weeks and there's 5 trading days, so it's $800. Let's subtract even $40 because let's take away 1 trading day because of the holiday coming up on Independence Day. So $760 in premium. $760 is definitely more than $300. And of course, I know this is assuming, and it's not accurate to assume so, that obviously that your cash, it'll never go below your cash occur put. Of course it will. I would expect it to, statistically. Even if you have a 70% chance of a win, you still have a 30% chance of a loss. And then the rule of large numbers are you do enough plays, and it'll become this statistic. So let's say you would even keep half of that. So divided by 2, you're still making more. You're still ahead of the game of doing a 4 week, and a little bit difference in your percent return makes a huge difference. And obviously, if there's a huge downturn, your 28 days also going to be vulnerable, just like your 1 day with the same deltas. Of course, there is a lot of research, and I've been doing research on the Tasty Mechanics, and they talk about, look at this chart. It's very interesting. They've done a research on the S&P 500. So there's something called the expected move and the realized move, and they went back to 1993. So the expected move is how much you expect the market to move on a given day or given period of time. Let's say before earnings season, you would expect a larger, move up or down because there's an event happening, or before jobs report, earnings report, homes report. And then there's something called the realized move. What is the actualized move in the end? End of the game, what actually happened? And the difference is this gives you an edge as a seller. There's something called the option seller edge. So that's why in the Tasty Mechanics they talk about how important 45 days to expiration is a perfect time, because they still have a lot of theta decay acceleration, but you still have, now look at this, there's a 5.7% in the S&P 500 expected move in 45 days, an up or down. But the actual move was a 5.2% realized move going back multiple decades. So that's difference of a 0.5% difference. That 0.5% difference is an edge you get as an option seller. It's obviously if you go 60, 90 days out, the longer you go out, the more the expected move is beyond the actual move. And they say that's not the case when you go sub 30 days, but they just put it all into one category. Now look at this. You see, the top line is the expected move. The bottom line is the realized move. And you notice the expected move is actually is smaller than the realized. It actually moved more than you expected. And the larger the expected move, the higher implied volatility, the more premium, but you're not getting enough premium to justify the move. But if you look carefully, you'll see on 30 days to expiration, the top line, which was the expected move, was 4.2%. The bottom line was the actual move, which was 4.3. We're talking about a 0.1% difference. But now, if you see, it's very similar to 7 days to expiration, where you have a 2.1% expected move and a 2.2% actual move. But if you notice in the middle, I feel like it's like a bell curve, because look at this middle part of 14 and 21 days. Let's go to the 14 days. The expected move was 2.5%, and the actual realized move was 3%. That's a 0.5% more of a move. If you notice, as you get closer to the shorter term, you go on the other side of the bell curve where it's closer. They didn't study 0 1 day to E, but maybe you can extrapolate that the expected move may sometimes be bigger in the 0 days to expiration or 1 day to expiration. Just my 2 cents. They also talk about gamma risk, and they mentioned that there is something called gamma risk, but the gamma, and that's a real risk you have with 0 days to 1 day expiration. And they mentioned that when you have a 45 day to expiration, you have 45 times less of gamma than a 1 day to 0 day to expiration. But they say a good way to mitigate the gamma risk is to remove your trade at the beginning of the day. If you compare the first 2 hours of the trading day to the last 2 hours of the trading day, there's 5 times less gamma risk according to the Tasty Trade. I was looking at their playlist they have a whole playlist on 0 days to expiration. So I was going through that and some of their videos, and they say that you definitely have relatively 5 times less gamma. So intraday, there's such a big discrepancy between closing your trade beginning of the day versus the end of the day. So that's why I like to do 1 day to expiration. It has definitely has more gamma, but not as much gamma as 0 day. And I can decide at the beginning of the day if I really want to take it on or off or roll it or whatnot. Anyways, that's just my 2 cents. I'm going to go on this journey and I'll share my updates with you guys, whether they're good or bad. I hope you guys enjoyed. This is The Working Investor, over and out.